What's up, landlords? Let's talk due on sale clause and if we're at risk with all these banks failing and what's going on with the market right now. So let's get started. I prepared some stuff just to start a discussion. I'm not 100% accurate on this stuff. I might leave out some details, or maybe I even say something that's wrong. Correct me, please. Give me your thoughts, your feedback. I'm just putting this out here as something to start the discussion. And I put together some stuff just to kind of like get it going. Alrighty, so the due on sale clause, we know what that is. You can go research the exceptions and stuff, but specifically, let's talk why they don't invoke the due on sale clauses of the banks in general. And then also consider the different tiers of banks. We have the lower tier, the mid tier, and then the top echelon of banks, the big 8, big 10, big 15. Well, in here, they're basically pointing out that a weak housing market is a reason why the banks won't call the due on sale clause, or let's say they know for a fact that the existing mortgage on the property is more than what it's worth. So they're not going to do it if it's going to be bad for them. But if the bank is in financial, troubles and they need money, what do you think they're going to do? When people are doing a bank run, they're pulling out all their deposits of their bank. They're going to go look for who's their existing company or customers are with loans, who's doing, breaking the due on sale clause, and maybe they will invoke it on them and be like, hey, give us our money or we're taking the property. Especially if they know you owe less than what it's worth. Just something to consider. I think this is just an example. Like if a married couple splits up, and only one of the spouses ends up with the house, that does not trigger the due on sale clause. But when that single spouse that has possession of it sells it, then that triggers the due on sale clause. But there's also cases where investors will approach somebody that wants to sell their house and say, hey, it's a lower interest rate right now, so let's draw up an agreement that I'm buying this from you. As long as everything goes according to plan, I'll service the debt even though it's in your name, and we are just going to try to skirt the system a little bit. And as long as everything goes according to plan, there's no problems, no black swan events, this works. And then maybe in the future they might refinance, and they could do pay off the original loan and actually can move the ownership into the new investor's name, the one that bought it. But technically it is a change of ownership when that happens, because the new investor is now the owner of it and they're servicing the debt. But it just gets messy. The point that I'm just trying to highlight here is the black swan events that happen and we don't expect it. So when you hear people say, oh, they've never called a due on sale clause, doesn't mean they won't do it in the future if something really bad goes with in the banking system. Anyways, continuing on, this was an article about why the Silicon Valley Bank collapsed. I know they tried to see if somebody would buy out the bank, but that didn't go through. So the Fed had to come in, and they were going to go under, but the Fed, this article right here explains that the government steps in to rescue all the depositors. So the people that deposited money in there, normally the way it works is the FDIC insured level is depending on the bank, but for the majority of them that I understand is $250,000. And if somebody has a really high net worth, normally they break that up into different banks so they don't go over the limit. But in this particular case, this bank, Silicon Valley, collapsed because all the money that they held on hand, they bought a bunch of U.S. Treasury bonds, I think like the long-term ones, like 10 years. And when they bought these back in the day, the interest rates were lower and the yield that these Treasury bonds were giving them were low yields. So when, the economy is like struggling right now, the interest rates are being hiked up. People are going and doing a bank run, they're taking out their funds, and the bank may have only had 10% of liquid cash or liquid cash equivalents, let's say securities or something that they could sell and get cash immediately and hand over to the people that deposit in their money or withdrawing their money. Well, once they exhaust all that and there's nothing left, then they're going to be forced to sell these bonds. And normally there's a market for these bonds, and if you hold it to maturity, you will get your money out with the yield that it's supposed to give you. But the problem is with Silicon Valley Bank, they couldn't go sell those because nobody wanted them, because the new Treasury bonds are having much higher yields because the interest rates spiked and now they're getting more for it. So nobody's going to want to buy their crappy low yield Treasury bonds. So they're forced to sell them like a big time loss. Anyways, none of that happened. The Federal Reserve stepped in, and that's a huge discussion because some people are saying it's not fair that they're getting a bailout, and depending on which political side of the aisle you're on, some people say that the Silicon Valley elites, typically lean one way and they kind of donate a lot of money, and that's obviously why they're getting rescued, because this is not a big bank, it's like a mid-tier bank. And also, it's not fair that they're using taxpayers' dollars, but they're trying to cover it, saying, no, it's not really taxpayer dollars, and we're not printing new money to do this. It's money they already had, but the money that they had, they originally got it from taxpayers. I know it just feels like crap when you're like a low man on the totem pole and you don't get bailouts like this, and when other people have made big mistakes and they're getting rescued, it feels not fair. So there's a lot of people arguing, but at least this is how I understand it. Maybe you guys can let me know where I'm wrong with this. But the people that are withdrawing their money from Silicon Valley Bank and other banks, they're actually putting it in the big banks now because they're feeling that the big banks are more of a safer bet. So here's an article I found that's talking about how the big banks, which are, I Googled this, 15 biggest banks, these guys are getting a spike in deposits now because people are thinking, hey, if I have a lot of money, let me put it in these bigger banks because they have less of a chance to go under. I was watching the news and I saw some stuff, so I looked up the Federal Reserve balance sheet. At the end of last year, they had a negative $18 billion loss on the books right here. And then I also, 3 months later, I looked up the most current one, and now they have almost double that, or actually more than double that. They have a negative $40 billion loss because it's in millions. So if you take this basically 40,000 times a million, that's where you get into the billion range, which is insane. And then there's this video talking about how they have a huge negative net worth. Let's see if you guys can hear this video.
Liabilities of about $8.6 trillion. It has assets of 7.4, and so it has a negative net worth of about $1.1 trillion because it did exactly the same as Silicon Valley Bank did. Or let's put it the other way around. Silicon Valley Bank did exactly what the Federal Reserve did. And therefore, they both took the losses as interest rates went up, bond prices went down.
Yeah, so it's getting crazy out there. And then now if you heard the Credit Suisse Bank, which is a European bank, but it's just crazy out there. So I figured I'd put this up here. They had to borrow a bunch of money from the Swiss Central Bank to be able to stay afloat because they're about to go under. And this is a mega bank. So this is not like the Silicon Valley, mid-tier bank. This is like on the world stage, a gigantic, huge bank. It's just scary, And then I just want to point out this loan to deposit ratio. Normal banks, a healthy, I don't know who exactly regulates this by state, or the government or country, but they're pointing out that healthy ratio is 80 to 90%, never 100%. 100% means for every dollar that a customer deposits in the bank, they're lending that amount out. And it doesn't really, a lot of people think that the money they put into the bank is what the banks are lending out. It doesn't really work that way from what I understand. They actually use our deposits as an asset on their books, and they use that as like leverage. Say, hey, leverage is like, hey, I got all this I'm in control of. Let me borrow because I'm this big of a bank, and you borrow to the ratio of how much assets on hand that you can control. I tried to draw a little diagram to explain it. Correct me if I'm wrong. This I could be off here, but let's say you got an estimated reserve requirement of 10%. So the circle is the 100%. Within 90% of that, they only need to have 10% that they can liquidate. Let's say like securities or cash on hand. So if depositors are coming in, most people are not, or withdrawers are coming in. Most people are not trying to pull out their money all at once. So 10% should be enough to handle the people, the demand, right? So what do they do with the rest of the 90%? They're like, well, we can't be too risky with this, but we want to kind of make some money. So the banks will say, let's buy some treasury bonds because they're kind of backed by the government and are safer. But if you lock them in for a long term, depending on what the yield is, which Silicon Valley Bank made a mistake, they locked in for like 10-year terms, very long. And as the interest rates go up, the yields the demand for the treasury bonds are down. So nobody wants to buy the old ones now because the new ones coming out have the higher yields. So they're locked in for 10 years. People come in to Silicon Valley Bank to pull out money and they exhaust the 10%. Now this 90% that's left over, they're forced to sell and making major losses. And they're kind of risking your money that's deposited in there, but this isn't what they're making the loans with. On their books, it says, hey, this is how much we're in control of. Now they create loans, and the way they make money is depositors less than the money they receive from people that are borrowers. So try to explain that differently is the people that put their money in the bank, they're trying to make a little bit of interest and they want their money to be safe. So that's why they got their money there. And then you got people that are trying to borrow money and they're going to give them a loan, and the interest rate that they're paying is well above what they're paying out. So they make that cut in between. Also, they have fees and other things that they make money for. So you can see I just made an incline that's higher because they probably make more interest off of the loans that they give out. And then the people that have their money sitting there that they think is safe is a very low, incline, low interest rate. So I don't know if that makes sense. I hope it does. But one last thing I want to do for us landlords to try to hey, how can we use this information and how do we be safe out there? I had the visual in my mind where like the strong base, and as long as you stay in the center as you're growing your portfolio and what you're doing with your money, if you stay close, tight in the inside, it'll be sturdy going up. But what happens is if we get a little greedy and we don't have a strong foundation, and as we go up we're swinging wide and we're taking risk and we're doing it, could topple all our progress and we fall down. So the yellow little notes I have is like, thin margins. Thin margins. We got low reserves. LLC. That's when, like, if the loan is investment property, it's in our name. I don't know if it's smart to be transferring it to an LLC with their potential risk of banks calling the due on sale clause, over leverage, excessive risk, so on and so forth. And then on the green side, look, we need to save. We need to be more efficient with what we're doing without, making a bunch of waste. Make sure you have enough insurance, spend less, avoid expenses. That's it for me. I just wanted to put this out there and start a discussion. I hope this was helpful to you guys. Just let me know what you think in the comments or anything. And I'll put the links to the stuff that I showed in the comment or underneath in the description, just in case you guys want to look into them. All right, guys.